Welcome to Multiple Perspectives. I'm David Lofgren. On this show, as you know, we explore the tools and strategies and sort of mindsets that help self-directed investors diversify their portfolios with alternative assets and unlock new streams of passive income. Today, we're going deep into a strategy that I think sort of challenges the traditional financing playbook that real estate investors may be familiar with. My guest, Amanda Taylor, calls it Frankenstein funding. It's sort of a trifecta of three different strategies, three different sort of lines of credit or sources of capital, including business credit, properly structured cash value life insurance, which we'll get into in the episode, and creative financing through all sorts of loans, broadly referred to as sort of non-qualified mortgage loans. And this approach is helping investors access capital more efficiently and sort of scaling into either cash flowing real estate or potentially building, institutional grade portfolios without the friction of all of this conventional financing that you may have heard about. Amanda is a real estate investor, a business strategist, a wealth mentor. She has about 10 different job titles. As the founder of Metropolis Business Development and Summit Property Investments, she's on a mission to help entrepreneurs streamline their businesses, access capital, and build legacies through scalable, passive investing strategies. We'll explore how Frankenstein funding empowers investors to diversify across multiple asset classes and how automation and structure can make this approach both efficient and sustainable. Before we dive in, make sure you're subscribed to Multiple Perspectives for more insights on fractional real estate, portfolio diversification, and private market opportunities. Okay, Amanda, welcome to the show.
Thanks for having me. I'm excited to be here.
So I'm curious, your background sort of uniquely blends a variety of things: entrepreneurship, real estate investing, wealth building strategies. What was the moment that you sort of realized that you wanted to take this sort of non-traditional approach to life?
It was an accident. It was a total accident. I was in dentistry practice management for 15 years. And when I moved from Texas to Colorado, the dentist I found a job with was only working 2 days a week. He was semi-retired and I needed something to do. A friend of mine said, hey, my husband and his partner just started this real estate investing thing. They need somebody to do their paperwork, like 5 hours a week maybe. And I was like, I don't know anything about it, but okay. And that was kind of a rest is history moment. I started working for them, like sourcing wholesale deals, doing their contracts, things like that. And the more I learned, I really had no idea what I was doing, but the more I learned, I was fascinated by the whole thing. And, 8 years later, I started my own company. I'm built my own portfolio. I'm doing all my own things, as well as starting other companies. And it just it clicked. It was like, this is the thing I know how to do, and I'm really good at it, and I'm really excited by it every day. So, total accident, but here I am.
So take me to the moment when you sort of have this realization. You get a part-time job doing some of this paperwork, but you're exposed to new people with a new set of ideas and strategies, maybe take on life. What was the thing that you started to go, oh, there's a different way here? Like, help me understand that experience.
It was absolutely the financing piece. Everything I knew about real estate was like, you go to the bank, they check your credit and your income, and you get a loan, you buy a house. I didn't even think about, investing as a method of income or anything. It didn't dawn on me. And when I saw that they were wholesaling, I was like, what does that mean? I don't understand. And then I was like, oh, you can do that? Every day I learned something new. I was like, you could do that? And so the creative financing piece for me, hard money and, sub 2 and seller financing and everything to me was so it was just that creative thing, the financing and all the ways you could do it was the most interesting part. And it just kept me, I want to learn more. I want to learn more. I want to know more because it seemed like endless possibilities.
Interesting. Okay, so you're going to talk with us a bit today about something that you call Frankenstein Financing. But before we get there, I'm hoping that you can just sort of explain to anyone who's listening who maybe doesn't fully understand what you mean when you say beyond the traditional. I think everyone that has ever thought about owning a home, currently owns a home, understands that you can get a mortgage from a bank. Given a certain set of conditions, you get a mortgage. It's usually a 30-year mortgage. You buy a house. It's the house that you live in. This idea of like accessing capital as a commercial real estate investor, as someone who's doing this, to make money as sort of a profession or a side hustle or something. Like, explain just sort of those different worlds to us briefly.
Yeah, there's owner occupied and then there's business purpose, like you were talking about. So to anybody that's ever been a landlord, and I kind of did that accidentally too. I moved to Colorado and the market was insane. So I ended up buying a townhouse. I was from Texas, moved to Colorado. I got a townhouse. I paid twice the money for half the house, right? And then when I was here for a while and was able to buy a single family home, I was like, well, we might as well just keep this one and rent it out. And that happens a lot. Some people just kind of, oh, well, we just kept that one as a rental. But in order to build beyond that, you've kind of leveraged all your personal capital there. And so you can get these business purpose loans, and there's tons of different ones, non-qualified mortgages, there's a lot of different, names for them. But to turn
lots of acronyms we can get into,
yeah,
right?
I'm like, nobody wants to hear me say non-QMDSER, blah, blah, blah. So, there's tons of different ways to do it and leverage all these different things to make it into a business, whether you are holding rental properties or, fixing and flipping houses. You get access to the right capital and know the right strategies, and you can turn it into a business that makes money.
Okay, so Frankenstein Financing is how you recommend that folks do this, and you have a business where you advise folk on how to sort of create this cash flowing, wealth stream. Maybe briefly explain what Frankenstein Financing is, and then we can go step by step into the details.
Yeah, wait till this gets famous. Disney's going to come after me and say I can't use Frankenstein anymore. But for now, that was the whole thing. You hear a lot, if you're in any real estate world, OPM, other people's money. You want to use other people's money, no money out of pocket, all these things. And there are lots of different ways to do that. The thing that we came up with that I love to use, and I think it's fantastic, is I start with a cash value life insurance policy. This was another thing I didn't know about. And I was like, why is no one talking about this? Why didn't they teach us this? But when I figured out, I'm going to put this money over here that's in a compounding, growing account that I can borrow out of my own money. I'm not using a bank. So I've got this pocket of money over here. And then we started utilizing business credit, which is also called credit card stacking, or EIN credit. Now with business credit, you have to have around a 700 FICO. You got to have a good credit score, which a lot of real estate investors I know have totally leveraged out their personal credit, flipping houses or doing whatever. I tell people you want to separate it as much as you can. So if you have an LLC that you're operating your real estate in, you've got an EIN, and you need to use that EIN to build up some credit on that side so that you're not tanking your FICO.
And to be clear, an EIN, that's an employer identification number that you just sort of receive whenever you file for a business.
Yeah. As soon as you create that LLC, then that means you have to pay Uncle Sam based on your income. And that means you need to have a separate number. It's kind of like the Social Security number for your business.
Right.
So if you have that number, you can build credit on that. So you can do it two different ways. If you personally guarantee it with your own credit score, if you have around 700, you can get a series of credit lines that are like business credit cards for introductory rates of 12 to 24 months, no interest. Fantastic.
Yeah.
You've got that right there on your business. Corporate credit is a little bit different. It takes a little longer to build up, but that is no personal guarantee. That is strictly on the business, and that builds up over time. And, I tell a lot of people, a lot of businesses don't really qualify for that, especially in this age of virtual digital businesses. But I'm at Office Depot. I have to keep files on all of my properties. I got a lot of paper. I got a lot of stuff. That's one of the credit lines. Home Depot, hello. They, they know me by name. My dog loves it in there. So there's a lot of different trade lines that you build up on that EIN to where you can ultimately grow over a period of time to have a like line of credit just for that business. So we utilize that. And then of course you've got your hard money loans, all those acronyms we were talking about earlier, the DSCR. Some people do HELOCs on investment properties. There are a few banks that will do that. So there's multiple ways to tap into different programs. Me personally, I'll utilize the business credit you can liquidate it, and I could put that as my down payment. And then I get the hard money loan to purchase the property. And then I pull from my life insurance policy to rehab. And then once I sell that property, pay everything back and take my money, and I go home and do it again.
Okay, so it feels like there's a few things that we should do deep dives on right here. So we have, the first thing you mentioned was this cash value life insurance. So we should probably do a bit of a deep dive on that one. The second one you mentioned is business credit or potentially corporate credit, depending on how you're able to sort of structure and show the credit for your LLC or whatever your business structure is. And then the third piece, if I remember correctly, we have those two. The third piece is some sort of like non-qualifying mortgage loan. So we're talking about something that is not your traditional bank mortgage loan, but rather something that, sort of is structured for folks who are looking for a more creative financing solution, right? So let's sort of like go through that capital stack and talk about all of those different pieces. So as far as like buying a house in the traditional way that we think of it, there are a few pieces to that too, right? There's a down payment that's usually expected, some percentage of the total value. Then you're going to have to pay into that whatever the standard mortgage loan that you would get. So there's sort of this like continuous expense of paying down your loan, the debt that you have on this building. And then you mentioned a third piece too, which is essentially if you're going to do any value add improvement to the property that you've purchased, this is an additional expense. And this is an expense that won't necessarily be covered by something like a mortgage or whatever your hard money loan is. So we've got three sort of sources of funding on one side and three potential needs for funding on the other side. First question, do you tie one of those sources and one of those uses directly one-to-one in each case, or do they sort of get mixed and matched depending?
They can get mixed and matched in a number of different ways. You could use the business credit for the rehab and the life insurance for the down payment. Obviously, the bigger bulk is going to be the purchase of the property, which will likely include one of those loans. I have done it before where I've gotten a loan in the first position for the purchase of the property, and then another loan behind it to cover the rehab. You got to know people to do that, but having a great community and being a trusted and experienced borrower helps with that. So there's, that's what I said. The thing that got me into this was the creative ways that you could structure these deals. And so I'm continually looking for ways to do it. Like I said, with little to no money out of my pocket. And, with the life insurance policy, that's still growing even when I've got money pulled out of it. So it's continuing to grow over time, which I'll do a deep dive in that all day.
Yeah, okay. So that's the one, I think, of all of these sources that you think, or that at least I hear life insurance policy and go like, no, there's no money for you to take out there. Like I die is the only way that money comes out of that thing, right? So explain this special life insurance policy that you're talking about and sort of how you're able to leverage it.
I know it's like if you're a fan of The Office, it's like Michael Scott's like, explain it to me like I'm 5.
Yeah, exactly.
Yes, it is life insurance, but your normal life insurance that you're thinking about is a term life policy, meaning I pay you this much money every month, and if I die, my family gets this much money. in my opinion, you are literally flushing money down the toilet. But a whole life, there's a number of names for it. Whole life, cash value, people call it infinite banking, family bank. It's all the same thing. You are buying insurance, life insurance. There is a death benefit attached. But the money that you are putting into that policy every month is compounding in interest over time. And it is essentially liquid. You can pull out of it and use it while you are still alive. Now, you're not taking your money out per se. You are borrowing against it. You are leveraging the money in your policy. But it's so if I have $100,000 in that policy and I borrowed 10, that 100,000 is still in there growing. And if
you're just using that as the collateral for the 10 that
you are using
borrowing.
the policy. So it's your own money and you're using the policy as your collateral.
Okay.
And you can do that as many times as you want to. Borrow it, pay it back, borrow it, pay it back.
And what's the sort of calculation of the expense of doing that? So I imagine you can't take that $10,000 for free against your insurance policy. How do you tend to look at that?
It is an arbitrage game, and I'll tell you another use case for it in real estate investing. I think my policy earns about 5.5% interest. If I take out of it, I have to pay 5%. So I'm still making interest, and it's way less than I would get from a bank or anywhere else. What I have done with it, in addition to my rehab or down payment, I also am a hard money lender. I can pull out of that at 5%, and I can loan it at 12, and then pay myself back with the 5% and keep that 7% myself. So that's the power of arbitrage. And you can do that for a number of things besides just hard money loans for real estate. It's the power of arbitrage.
Okay, so tell me the name of that type of life insurance again.
Cash value or whole life, or people call it a family bank. Be your own bank. This is something the wealthiest 1% do. And that's why they're the wealthiest, and they pass it down. It really builds generational wealth. I say start as early as you can and grow those policies. I think my contact information will be in here. I have a partner who does sell and structure those policies specifically for real estate investors because they can be structured different ways for different benefits and uses. But that's our whole thing is like, let's design our structure and our strategy around acquiring property and just do it over and over and over.
Purpose built for commercial real estate investing. Okay, cool. So we've got our cash value life insurance or whatever you want to call it. Check. The next piece I think we talked about was business credit. So talk to me about, I think there are a lot of people that are probably listening to this and saying either I don't have a business, at least not yet, or sure, I have an LLC, but it's for my, like I have my own practice or whatever. Like this is something that is strictly for a different line of work. Step one, just open an LLC, pay the $200 or whatever you need to do and like start your business.
For an example, I started another business. So I opened a new LLC on November 5th. I started my business credit on November 9th. By the end of that day, I had $95,000 in business credit. There you go.
All right.
At 0% interest.
And that is tied to, at least initially, that's tied to your own personal credit history, right?
It is guaranteed by my own personal credit history, but it is on the business. Yes. So if something defaults, yes, it can come back on me. But because I have good credit, they're like, oh, we see that she's got it. She's fine. So yeah, that's the one that you have to personally guarantee. And I consult with a ton of investors, whether it be real estate or business owners trying to grow their business. And I caution everyone, I'm like, this is a tool and you have to know how to use it the right way. Exit strategy should be the first thing you're focused on when you start anything. And how are you going to pay this off? Because that introductory period of 0%, great. You can go max it out day one. And then, you know,
You've got 12 months to figure out where you're going to get that money.
Figure out how you're going to pay that off.
Right.
So you have to know from the beginning what your plan is to either break that up into monthly payments that you know you can handle, or have a clear exit strategy for that investment that you know well before that 12 months that that's going to be paid off in full.
Right. Got it. Okay. And you're saying that, I mean, $95,000. So that's like, often you would use this line of credit to do what? Pay for the down payment, maybe do some of the rehab or the value add?
Yeah, that's pretty much what I would do with it. You can use it for holding costs as well. If you've got, while you're sitting on that property and it's undergoing any renovations or value adds, I mean, you're still going to have to pay insurance. You're going to have to pay any utility bills, aside from the contractor and the materials. So you could use it for that as well.
Sure. Okay. I feel like a credit line is pretty straightforward. Even if it's for your business credit, we understand that, this is something that we all deal with on a daily basis. You mentioned the potential of corporate credit. How does that differ? Give us a little bit of color on like exactly how that's different from just your standard business credit.
Right. So business credit is essentially credit card stacking of business credit cards. Like Chase is going to give you a Chase Business Inc. card. There you go. Corporate credit is different. It's tiered in 6 tiers, and you get an account manager to like work with you through all the tiers. And tier 1 is your basics, like I said, Office Depot, other things like that. So you just do small purchases, buy a pack of paper, pay it off. So you're building up to the next tier. When they see that you've made good payments, you can get the next credit line.
So this is just opening like corporate accounts essentially.
Correct.
Through third parties.
All on your EIN. There is 0 personal guarantee. This is all on the business. So then they've got gas cards in there, corporate gas cards. So I don't know about you or any other investor. I am in the car 90% of the time driving from project to project. So gas card, great. Put gas in the car, pay it off. And you keep going through those tiers. Some of them start off, like I said, Office Depot, gas cards, Home Depot, like they're credit cards. But then when you get to that level 6, these are bank credit lines that are secured by the business wholly. You are not personally responsible for those.
Great. Okay. And I imagine those are probably significantly higher credit lines than you would say be able to get on day 2 of having your business open.
Absolutely.
On the business credit.
Yes.
Right. Okay, cool. So we've got those 2. And now we've got one more.
It's all the loans you could think of. My partner is actually a lender, and he wrote a book recently, 101 Loan Programs to Get Through Life. And I'm like, nobody wants to read that. But they exist. And that's all you need to know, is that somebody knows they exist. And I have a business development company. I work with a ton of entrepreneurs. Even for our own personal residents, I don't have a W-2. I can't walk into a bank and get a home loan. They're going to tell me, see you around. So we advocate for those non-qualified mortgages because there are a ton of different ways you can buy a house to live in, let alone an investment property. So there are loans available for that. There are loans available specific for rental properties that are only based on the cash flow that you're going to get from it being rented. So there's a ton of different ways to get a loan to buy or hold a property. You've got hard money, which is expensive, and same thing. Like, you got to know your exit strategy and how you're going to pay that off. And having good relationships with some private lenders is great if you can do it. I was able to get a private lender friend of mine to do 100% LTV and rehab for 4%. But I gave her 25% on the back end when I sold it.
Okay. Okay.
Creative,
Yeah,
right?
very creative.
Creative.
Interesting. Okay, so but obviously there's a 101 apparently different potential loans you could get here. I think anyone who is not already part of this world is probably thinking, this sounds like a lot of different things to try and figure out. As you say, you want the exit strategy at the forefront of your planning for this kind of thing. So on the way into this type of approach for commercial real estate investing, how do you recommend people start to do the research, try and figure out, how to assess the potential risk in these scenarios? Are you like building a business plan from the get-go and saying, well, if I can find a home that fits, or a quadplex or something that fits this profile, then the numbers pencil? Like how much of this kind of advanced planning are you doing before you even start, inquiring about loans?
I have a pretty specific buy box that I call it. Like, I will only look at this kind of type of property. Now I'm moving into multifamily, so I've got to refine that a little bit. And I have a very craftily designed Excel spreadsheet. I'm a spreadsheet nerd. So, and I have it designed by different scenarios, whether I'm going to hold it, whether I'm going to sell it, different scenarios, and plugging in all those numbers. And there's kind of a bottom line there that it has to make sense. And I've gotten really good at saying no. I think that's something that newer investors have a hard time with because they're so desperate to get their first deal. They just look at it and they're like, I mean, it's close. I think it'll work. And then 9 times out of 10, it probably doesn't. You've got to leave yourself a pretty big margin on any deal. Just overall, stuff happens. It does. Takes longer than you thought, needs more work than you thought. There's hidden things everywhere. So I am very careful on those numbers at the beginning. Like I said, I want to give myself as much opportunity as possible to succeed. And that's why I say exit, have your numbers. So yes, I'm very diligent about that at first. And I get people sending me opportunities all the time. And it is because I know the market that I'm in so well. I'm also an agent. So I have kind of a bigger view of it than some other people. And I've been doing it a really long time. And people who bring you deals will often overinflate the value and underrepresent the rehab budget. So
Right.
keep that in mind all the time. So it's just about...
We've all seen the rosy pitch deck before. We go, I think some of the assumptions baked in here might need to be questioned.
I don't know what you're looking at, but yeah. So it's my just advice to anybody getting into it for the first time. Yes, I just talked about a ton of different financing things you probably never heard of. At the end of the day, the acquisition is where you make your money. So if you're not very clear on the property you're getting and how you're going to then make money from it, then you need a mentor. You need a person who really knows that industry, that area, the forecast for those things, because trying to do it on your own in this space at this time is extremely risky. Everything comes with risk, but you can be more risk aware than risk averse and, do your due diligence to protect yourself as much as you can.
As someone who's, sort of looking at these deals on a regular basis and transacting, whether it's as a broker or an agent or as an investor yourself, obviously there are a lot of X factors, there are a lot of variables that can be taken into consideration when you're penciling out that deal to begin with. How do you collect that kind of information? How do you think about, not only figuring out how your various capital sources are going to match whatever your business plan is, but also, trying to figure out how demand will be in a market over time, sort of trying to pencil in those assumptions? Are you like reading the trade rags all the time? Are you, do you have some sort of proprietary data source that you're looking at?
I wish
Well, yeah.
I'd be rolling.
Right.
No, my goal really is to work closely and directly over my contractors to make sure it moves fast, because we're going with the data we have, and that can change at any moment. So we know usually within a few month window of what we're looking at. So the key is keeping the project on the right timeline. And, part of that is experience and knowing how long certain things are going to take, and giving yourself a buffer, not only in time, but in money. I typically add, a certain percentage in my budget for buffer. Because
Yeah.
just put it in there. It's going to
Yeah.
probably happen. 9
Call it
times out of
the
10. You're going to need it.
fund. Yeah. Okay. So it sounds like, and correct me if I'm wrong, but it sounds like part of the strategy here is trying to either get to lease up or get to your, whatever your exit strategy is, sale, in a time frame where the sort of macro environment of whatever market you're working in looks very similar to now. Is that true?
Yeah. And, there are people who will take on projects that are going to be, a year to get permitted and rebuilt and all these things. And that's great. More power to them. That's just not my buy box. And I want to do the things that give me a better chance to succeed. So that's where I choose to play.
And you're based in Fort Collins, right?
I am in Fort Collins, Colorado. So northern Colorado, Denver, and around is my sweet spot right now. Mm-hmm. But I'm investing outside of the state. But that's, got to know your people too.
Yeah. I was going to say, so, one of the things that we think about a lot in the sort of, crowdfunding space is this idea of diversification, that, diversifying across asset classes, whether it be sort of business models or the specific niche of real estate, industrial, commercial, retail, whatever, across geographies. Like, I think this is something that's, say, easily accessible if the minimum that you have to put into a deal is $10K or $20K, that kind of diversification is made pretty easy in a situation where you're not actually also in charge of making sure the contractors are staying on top of the job. How do you think about diversification in this direct investment approach? How do you think about not putting all of your eggs in one basket, especially when, step one is essentially you have to buy your first basket.
Right? Yeah. I mean, you have to start somewhere for sure. And some people could start just doing the crowdfunding or fractional ownership or anything because they don't want to deal with it. And that's why I love real estate investing. I've got an entire platform, separate from my real estate, educating and empowering women just in financial literacy overall, but specifically towards investing. And it's not just real estate. I mean, we have so much opportunity to invest in alternative, asset classes, investments, so many things to build wealth, real estate being, one of my favorites. But I diversify along that: venture capital, private equity, precious metals, your insurance policy is an asset. So I'm very much into investing. And so real estate in particular, you don't have to be swinging a sledgehammer, knocking down cabinets like HGTV to be a real estate investor.
Right.
You can put your money to work, and that's all that really matters. So if you want to have a rental property and manage a rental property and deal with toilets and bugs and stuff, great, do it. But if you want a more hands-off approach where you're with a group that you trust and that money's going to get you a return, that's a great way to do it. But I always recommend having multiple buckets. And you can have multiple buckets within real estate. And that's why it's such a great opportunity.
Right. Is there any way to sort of diversify the I think that the thought of like sourcing capital through, let's say, your business credit and your life insurance, like it feels like it might be easy to get out over your skis pretty fast if you have a lot of different credit lines out, or if you don't really fully understand the way that all of these different, sort of capital sources work. Do you think of an approach to diversification there as well? I mean, obviously, if you're saying 3 different capital sources for one potential project, there's some diversification, sure. But like, is there some way that investors can sort of protect themselves by thinking, listen, I'm pulling from a lot of different pots here, or sort of have a different, at least like credit timelines or something?
Absolutely. And the credit lines, the corporate credit is a different thing. When I talk about the business credit, the corporate credit and those lines, that's a totally different thing. Business credit and credit card stacking, that's a limited tool, because you can't just go open a new LLC for every project you do and get more business credit cards, because you're still personally guaranteeing it. And there's only so much you can get from that pool. Like I said, it is a tool. If you're looking to get into something and you need that runway of capital, that is a tool. And like I said before, we have a coaching program called Expand Your Empire, and teach those strategies and really help people understand how to use them responsibly. So I advocate for you to educate yourself and have your plan for payoff. And so that is a limited time offer, so to speak. So you do have to I would recommend going to your RIAs, local RIAs, and meeting people who are lenders, building relationships with them, and protect your personal credit as much as you can, because people are looking at you when you're going into these projects and you're the borrower, and they want to know that their money is secure with you. So I've met a lot of lenders through those groups, and then other investors who may be doing their own projects, but they're also lending. So just building out your community is a huge way to get access to different financing.
Networking.
People hate it,
but man. In
the
21st century, who would have thought?
Who would have thought? Spend most of my life doing that.
Right. These are still relational businesses in the end.
Absolutely. And that I wouldn't be where I am if I had not built the relationships I've built. And, it's a very small niche in where I am in particular. It's like people know, oh, I know him. I may have met him once, but I know that guy. And so, word spreads and people know each other, and people send each other, like, I can't do this. Do you want to do this? Do you have somebody who could lend on this? And it's just, your community is your best source of everything.
I love that. I find your story pretty inspiring in that, you sort of maybe by happenstance found yourself into a place where you were exposed to these new ideas and just thought, this is it. Like, this is the thing that is going to sort of spark the next chapter of my life. And now you're in a place, you've positioned yourself to be that person for other people, to sort of expose them to these new ideas and to help them understand that there are other options, right? There is some freedom around the corner that maybe you didn't realize existed. I think, it's one thing if you're surrounded by this all of the time, but if you just occasionally bump into these ideas, it feels like there's a really big sort of shift that you need to make, like a really big shift that you need to make to even believe that it's possible. What do you say to folks to help them, start to make those shifts in their life to recognize?
I'm so glad you asked. That's what I have a couple different sayings. Like, you can't read the label from inside the jar. So those of us who are in it, we just think this is normal. So when I start talking about all this stuff and saying it, other people look at me like Charlie Brown's teacher. Wah, 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 wah.
Yeah.
But my whole motto within, I have an Investing 101 course and a community to teach about investing, is education and intimidation have an inverse relationship. So the reason you may be afraid to step into something or unsure is because you just don't know it yet. And if you can just take the time to learn from a trusted source a few things to dip your feet in, get more comfortable with. I mean, let's start with the basic terminology. This, we're throwing out a bunch of acronyms and stuff. Just learn about it. Just like I did it. I'm like talking about wholesaling and I'm like, I don't know what that means. Or I'll be having a conversation with someone on the phone and they say a acronym or whatever, and I'm like Googling it, like, what does that mean? I don't know what that means. But you learn, you figure it out, you kind of immerse yourself in that community again. And I have found in my neck of the woods that it's a very supportive community. And, everybody wants to talk about it, wants to share ideas, wants to share, referrals for contractors or this or that. I think it's a great community to be a part of and learn from.
And if folks want to join that community, we will have all sorts of links to your work in the show notes.
Yes.
Amanda Taylor, thank you so much for coming on Multiple Perspectives.
Thank you. This was really fun. I appreciate it.
Well, that's it for this episode of Multiple Perspectives. Thanks again to Amanda for joining me. If you enjoyed today's discussion and want to hear more of what Amanda has to say about real estate investing or creative financing solutions, you can find links to her work in the show notes for today's episode. If you want to learn more about the real estate investing opportunities we have on the Equity Multiple platform, we've got links for that too. Thanks again for joining me here on Multiple Perspectives. I'm David Lofgren, and as always, you can let me know what you think of the show via our email, multipleperspectives@equitymultiple.com. See you next time.